This week, the market sent some seriously mixed signals. I mean, on one hand, the Fed cut interest rates, and stocks are right near record highs. But on the other hand, well, market rotation is picking up speed, and volatility risk is definitely rising.
So, what are we supposed to make of all this? Let's dive into what really mattered this week and, more importantly, where the money seems to be moving as we head into 2026. We'll make sense of it in just a few minutes.
Okay, everything this week really kicked off with this single biggest event, the Federal Reserve's interest rate decision. And yep, they did it. The Fed cut its policy rate by a quarter point, which puts the new target range at 3.5 to 3.75%.
But here's the crucial point. The Fed was super vague about what comes next. They've pretty much adopted a wait-and-see approach, and that creates a ton of uncertainty.
And that uncertainty, well, it immediately changed what everyone expects from the economy. And that caused a major shift in where investors are putting their money. This is a classic case of what we call sector rotation. Basically, money just flows out of yesterday's winners and into potential new leaders, all based on where people think the economy is going next. And this really shows you the split, right? Money's moving into cyclical sectors, think industrials, communication services, and healthcare, that tend to do well when the whole economy grows. And it's moving away from those really concentrated AI-driven tech stocks. You gotta ask why, right? Well, there are concerns the AI rally is just too narrow, and even some risk of weird stuff like circular financing, so investors are looking for broader market performance. Now, what's really fascinating is that the Fed's move isn't happening in a vacuum. There are a bunch of other economic forces creating some real instability. First off, the labor market. It's been resilient, for sure, but it is showing clear signs that it's slowing down, and that just complicates the Fed's job. Second, oil prices are dropping. And this isn't just about a potential supply surplus, it's also a big signal about worries over future global demand. Third, we're seeing a rise in M&A activity. Now, this is a classic risk-on signal, and it totally clashes with some of the other cautious data we're seeing. And finally, you've got gold. The classic safe haven is just kind of stuck. It's in a holding pattern, reacting really cautiously to the Fed's vague stance. You put all of these conflicting signals together, what do you get? Well, it paints a picture of what people are calling a K-shaped, or two-speed economy. Some sectors are growing, while others are stalling out or even declining. So let's move on and see how this all builds into what you should be watching next. Let's find that signal in the noise. To cut through all this, here are the 5 key signals to track heading into 2026. First, the Fed's path. Will they signal more cuts or maybe a pause? Second, the rally's breadth. Can the gains broaden beyond just a few AI giants? Third, that labor trend. Will the job market slow down gracefully or weaken sharply? Fourth, the direction of oil. Are lower prices a sign of economic weakness? And fifth, gold's response. Will it finally break out or just stay stuck? So the key takeaway here is that this isn't just some temporary shift. The market is adjusting to a whole new reality, one with higher instability basically baked in. And that means being successful might now depend less on predicting the market's overall direction and a whole lot more on just navigating its constant churn. So it's less about which way is the whole market going and more about where is the money moving within the market. And that is the real signal to watch.